This is the first 50 basis point rate hike in like 2 decades. If you cause demand destruction, then you can potentially reduce inflation for a period of time, but then the cost is a recession. The melt up was the past couple years because we had what in some ways was a very, very sharp recession due to the lockdowns and everything, and yet the market went straight up. And that's because of all the record amount of liquidity going into the market. And if you look at most charts, it looks like a melt up. So you can argue that we've already seen the melt up. Now, you could get another one if basically the Fed is forced to ease into an inflationary environment, and other central banks are doing the same. Essentially, what I would kind of point people to look at is what happens in emerging markets during recessions. Because often, if you look at what's happening in their stocks in local currency terms, they're going up because it's rather inflationary, and the unit of account is what's going down. But if you look at their stock market in dollar terms, it's really not great. Same thing is, if you look at Turkey, for example, because inflation's so high, their stocks are actually doing pretty okay in lira terms. And so I think that if you see that kind of thing, maybe to a lesser extreme, happening in developed market currencies, you get kind of the same phenomenon where maybe stocks in nominal terms don't do terrible, but if you price them in something like gold, for example, the chart will look much worse. Or there's a basket of hard goods, maybe a basket of commodities. I think that they are going to perform poorly in that environment. I think that's why they're trying to tighten now so aggressively. I mean, this is the first 50 basis point rate hike in like 2 decades. And I think they're trying to regain some of their credibility. And I think that's why they're, even though we're clearly in a downturn by leading indicators, they're still kind of pushing it because it's kind of the last grasp to try to stabilize and try to have some ammo for their next easing. But yeah, I think we're kind of past the point where they have a lot of credibility. I think especially, even not just the Fed, if you look at, Bank of Japan is pegging long duration yields at 0.25%, so yield curve control. And then you have the ECB, which has a problem because different countries have different debt levels. And so, if they try to tighten, then some of the southern European countries, like Italy, with the amount of debt they have and no foreigners want to buy it, are in trouble. And then their spreads blow out. And so all the major central banks have pretty significant, credibility issues around their ability to tighten. Whereas, ironically, if you look at some of the emerging market central banks, Brazil's been tightening for the past year, and they're at double-digit rates because they're taking all the steps they need to try to rein in inflation and try to make their currency offer yield that's comparable to inflation, whereas it's the developed market central banks that have been really behind the curve because they're the ones that have so much debt. If you cause demand destruction, then you can potentially reduce inflation for a period of time, but then the cost is a recession. And so there is a reverse wealth effect, right? If you damage enough value of stocks, houses, and bonds, some segment of society will spend less, and they'll be more uncertain about business plans. They'll, maybe hire less, get more slack in the unemployment market. And you even have Fed officials say we might have to cause a recession. Some of them have been saying that. And so, what's more politically unpopular, inflation or a recession? So I think that, for periods of time, they can pull back a little bit on inflation by taking some of the excess demand out. But the supply side's still tight. So the Fed can't print oil, they can't print chips, and that takes time. And especially in oil markets, we're not really seeing a supply response yet. And so I think until we basically have abundant commodities again, we're going to be flirting with inflation for off and on for periods of time. There's a couple factors. One is, even though mortgage rates have gone up sharply, they're still below the inflation rate. And so it depends on someone's assessment of forward inflation, right? If they think inflation is going to come down a lot, maybe those mortgage rates will come down. So I think right now, it's also very zip code dependent. Where I'm based in the Northeast U.S., we don't really see a housing boom. We kind of skipped a lot of that during the whole housing boom this past couple years. And then we're still, whereas other markets had a much sharper rise, basically where people are kind of moving to. And so I think it's zip code dependent, and I think there's still residual, kind of euphoria there. But I think most signs show that at least on a nationwide average, we're kind of leveling off from that sugar high we were in terms of housing. So unemployment is pretty lagging as far as the economy is concerned. We're starting to see initial signs of initial claims starting to rise, initial jobless claims. And so we're seeing very early signs of slack in the labor market, but the official unemployment's low. So like a lot of other indicators, like the leading stuff that kind of comes before unemployment has already been flashing, if not red, at least yellow. And so unemployment's kind of slowly starting to maybe wake up to that and maybe start to drift higher. And then when you look at the commodity supply chain, basically oil and gas are the master commodity, and then it trickles to everything else.
Yeah.
So now the cost of running equipment to mine copper is higher, and then the cost of making fertilizer is higher, and therefore the cost of food is higher. And then when you have Russia and Ukraine responsible for a significant portion of the world's wheat exports, that's an issue. And so we see a lot of protectionism among countries, and then you have less efficient distribution of some of those. So basically, I think food inflation follows some of the things we already saw, unfortunately. And so I've actually been in that camp. I think we might be reaching a high in bond yields, but I'm watching for the market to confirm that, right? So it's not like I'd say it's a position loosely held that until we see higher highs, then I would change that. But assuming we don't see higher highs in yields, there's a case that even though the Fed's not done tightening, the market expectations about how much the Fed's going to be able to tighten, we might have already hit a peak there. And so I think that they're pivoting from looking at inflation to now looking at inflation as well as economic deceleration in many countries. And they're saying, how much are they going to be able to tighten? And so I think that we might have hit peak tightening expectations, even though we haven't hit peak tightening. And that's something I'm keeping an eye on. I mean, if you had a total capitulation, like if you had a pivot in Fed policy and a reliquification of markets, it's a pretty high volatility asset. So you could have a pretty big swing up. You could retest some highs. But I think that's not the right way to think about it. I think when you look at Bitcoin, it's about what is the probability of where it is 3 to 5 years from now, and decide whether or not you want to have an allocation to it. So I view this as a good place for dollar cost averaging, and I view it as a very uncertain time for trying to forecast 6, 12 month price changes. If you dig into the actual what's happening, who's buying it, why they're buying it, what are the fundamentals, I was like, I don't think it's going to capitulate as far as you think, in terms of like some of these other stocks have done. They were just inherently overvalued. And so I think it has held up better than a lot of those tech stocks. And I think that's probably going to continue, even though I have no idea if we've actually seen the bottom or not. I mean, we've seen a pretty significant capitulation. I mean, I think everybody's going to have a different approach. Mine is to be diversified, right? Because, if you're not over allocated any one asset, it gives you serenity to kind of just move through the environment. And so a 60-40 portfolio is not great because both broad stocks and bonds are basically, they benefit from disinflation. They want yields going down, they want commodity prices to be low. Whereas I think if you enter a more stagflation or inflationary decade, you want a better mix. So you maybe want equities, but you want more value-oriented healthcare, energy producers, pipelines, things like that. You want commodity exposures, some cash for, capitulation events, rebalancing, things like that.